insurance world changes again. My name is Donna Yother, and I am the president of SAVA Insurance in Waterford, Connecticut. I have been an affiliate member of ECAR since 2001 and currently serve on the affiliate committee. This webinar is going to be the first in a series of webinars the affiliate committee will be releasing. We hope you find our webinars informative and helpful when you're working with your clients. Today we will review the recent changes to the flood and homeowners insurance programs. Some are going to be good changes and others are going to impact your clients. The flyer stated the webinar will be 1 hour. However, this presentation is only going to run around 20 to 30 minutes. That's good news for all of us on a Friday afternoon, right? So if you have any questions to the webinar, you can go ahead and type them because we are muting you on this. And I'm being joined by Catherine O'Leary from ECAR, and she will be managing your questions. The hope is that we will be able to answer everything today. However, if we can't, I promise to get you the answers by Monday. If I have to come in over the weekend to do that, you'll have the answers to your questions. So let's begin. The webinar topics again, the flood insurance program and homeowner coastal property changes. And it's going to start out with who needs flood insurance? Well, all owners of insurable property need flood insurance per the National Flood Program. Most of the floods that happen are in 25 to 30% of areas that are in low to moderate risk areas. So if you think about that, 25 to 30%, that number is pretty high. And of course, if you purchase flood in a lower risk area, the premium would warrant the lower premium because of the area and the less severity chance of a flood. The history of the National Flood Insurance Program, it was established and passed by Congress in 1968. The Flood Disaster Protection Act was amended in 1973. The program is administered by the Federal Insurance Mitigation Administration, a component of the Federal Emergency Management Agency, which is FEMA, and I'm sure you've all heard of FEMA. The flood insurance is a federal program, and any changes to the program are voted into law by Congress. On this slide, what determines a flood risk? Well, a flood risk is unique to each structure and depends upon factors such as the elevation of the property, the construction style, and the building, and the flood risk zone. FEMA publishes flood hazard maps that show predicted flood levels and flood risk zones based on historical climate information and the best available science. FEMA also provides flood risk information to communities to adopt into their flood ordinances. A definition of a flood which the National Insurance Program uses is a flood insurance covers direct physical loss caused by flood, general and temporary condition of partial or complete inundation of 2 or more acres of normally dry land area or of 2 or more properties, at least one of which is your property. And that can be from overflow of inland tidal waters, unusual and rapid accumulation or runoff of surface waters, mud flow, collapse of land along the shore, lake, or similar bodies of water as a result of erosion caused by waves or currents of water exceeding normal levels. That result in a flood is defined above. There's several different kind of flood policies, forms that they can issue the National Flood Insurance Program. There's a standard flood insurance program, which is also known as the SFIP, which is for dwelling forms, primary and non-primary residences, commercial properties. Then you have the preferred risk policy, which has to be your principal residence. You have to insure it for at least 80% of the replacement costs or the maximum allowable by NFIP. And residential condominium building associations, also known as RCBAP. There's also pre-firm and post-firm. It's very important part of the policy is how they determine the rating. So the firm, which is the flood insurance rate map, is the official map of the community where FEMA has identified a flood risk zone for each property. And they establish the base flood elevation. Then you have the pre-firm, usually much higher premiums. If you hear somebody's in the pre-firm zone, you'll know that it's higher, due because the buildings were built or substantially improved prior to December 31st, 1974, or prior to the date that the community entered the regular program. Before building codes were enforced and flood maps were implemented, so there was a lot of flexibility when you built a property and how you were going to do that and where the basement was going to be situated and how deep the basement had to go into the ground and things like that. The post-firm building was built or substantially improved after the community enters the regular program. The building codes were in place and they were established, and they also had FEMA, and the maps were out there. So building codes got much more stringent as far as where buildings were going to be located in flood areas. There's also SHFA versus non-SHFA. SHFA is a special flood hazard area. Rates are going to be very high if someone's in SHFA. It's due to the floodplain maps, a 100-year floodplain with 1% annual chance of a flood, at least a 26% chance over a 30-year period, and high-risk zones comprising of the A zones and V zones, which most coastal properties, if they're in a flood zone, they're going to be in the A and V. The non-SHFA rates are very competitive. They're moderate to low risk, B and C zones, and an X zone. Here's the problem that we had with the flood insurance program Congress had to deal with. Due to the number and severity of claims from Katrina, the National Flood Program became unprofitable very quick. Congress had to come up with a way to turn the program around to profitability. Their solution was to come out with the 2012 Biggert Waters reform. If you think about it, Katrina cost in 1992 $21 billion. So think about a program of national flood paying out $21 billion and trying to be profitable at the same time. So what Congress ended up doing is they came up with the Biggert Waters in July of 2012, which the whole goal was to immediately move to property-specific full risk rates for pre-firm properties that were sold, any new policies, or policies that were canceled and had to be reissued. Some policyholders saw significant increases, and also some people had to go and get their elevation certificates because now it was required for new and lapsed policies. In January 2013, they eliminated the grandfathering policies, which was something that was used in the past, and I'm going to touch on that a little further in my slides. It was also any non-primary dwelling changes, 25% of the premium increases until the full premium was reached. They were no longer going to subsidize the premium, and I'm going to talk about subsidizing the premium later in another slide. Required all policies to be set up on an escrow account where the insured could no longer pay the premium. And they also, the pre-firm properties with subsidized premiums in the SFHA, Special Flood Hazard Area, or Zones D, will increase 25% annually until the full actuarial rate is achieved. Business properties and any non-residential buildings that produced income or a building design used for an office, retail space, or wholesale or hospitality was also impacted. Well, then in October 1st, 2013, the Biggert Waters Act went through another change. Congress ended up voting in a few more things that they thought could improve the profitability. Properties with severe repetitive losses consisting of 1 through 4 family residents with subsidized premiums, pre-formed buildings in SHFA or Zone D will increase 25% annually. Policy fees increase so they could get some money. Lender compliance fees increased. What they were doing was they were regulating the mortgage officers and the banks. At one time in the past, they would only charge, you would be fined up to a certain limit. Well, what they did is they took away that cap, and for every thing that didn't pass the audit when the regulators came in, they were charged. And some banks were experiencing all of a sudden getting charged $5,000, $6,000, $10,000 instead of the minimum $350 cap. In January 2014, premium rates for other properties, including non-subsidized properties, will increase. Revised flood maps came out, and the full risk rates are phased in for these properties. Additionally, if you built to a minimum standard today, you will be subject to significant rate increases upon remapping if your flood risk changed in the future. Well, then Congress had to sit down because that wasn't working either. Everybody in the communities were screaming, saying that the rates were going up. We were seeing premiums go $5,000, $8,000, $10,000. So they came out with something else, which is the Homeowners Flood Insurance Affordability Act. With the Flood Insurance Affordability Act of 2014, they repealed and modified some of the Biggert Waters Flood Insurance Reform Act of 2012. If you're getting confused, believe me, everyone's been confused through this process, and I hope we clarify some of this for you as we go forward. The new law pulls back on some flood insurance rates increases and offers relief to some policyholders who experienced deep flood insurance premium increases in 2013 and 2014. Well, now we're in April. 2015 is coming up. Well, there's some more changes coming. In addition to the insurance rates, other changes resulting from the Biggert Waters and HIFA will be implemented that will affect the total amount the policyholder pays for a flood insurance policy. Some highlights of those changes: there's the increases in the reserve fund assessment, the implementation of annual surcharges on all new and renewed policies, increase an annual surcharge on all new and renewed policies, additional deductible options, which they did offer a higher deductible. At one time we were capped for the deductible. They're going to be releasing a $10,000 deductible option for the clients to try to give some rate relief. They increased the federal policy fee, and you're going to see rate increases for most policies. And some more remapping was done. Properties newly mapped in the special flood hazard areas, they're going to be impacted on the renewals. So what is subsidized policies? A subsidized policy is one that does not pay the full actuarial rate and is not reflective of the true risk of the flood to that property. Homes located in the high-risk flood zones, the A's and the B's, and built before the flood insurance rate map became effective, and that have not been substantially damaged or improved, may currently be receiving subsidized rates. Years ago, almost all flood premiums were subsidized, so people really didn't know the true impact of what the real actual rate should be. So another big change is an elevation certificate. We weren't required to submit the elevation certificates when we were out seeking rates for a flood policy, not too often. Now you hear elevation certificates, especially in New London County where we are a coastal community. You hear it all the time, which is going to upset your buyers because they're not cheap to get either. But the reason they're looking for the elevation certificate, it provides elevation information for the community to document its compliance with the floodplain management ordinances. They also are required to rate the flood insurance on structures that were constructed after the publication of the FIRM, the Flood Insurance Rate Map. Going forward right now, any property that's an A or B requires a flood elevation certificate for us to issue a policy. And you probably hear your clients talk about that if they are in a flood community. The elevation certificate, what are they? When are they required? Well, who can complete an elevation certificate? Elevation certificates must be prepared and certified by a land surveyor, engineer, or architect who is authorized by the state or local law. Community officials who are authorized by local law or ordinance to provide floodplain management information may also sign the certificate. Well, because the supply and demand, we all know about that. Elevation certificates used to be around $350 to $500. We've been seeing them going up to like $500, and I know in one case a client paid $900 for an elevation certificate. Options to remember. As of January 1st, 2011, buildings that are newly mapped into a high-risk flood zone are eligible for a lower cost preferred risk policy. That came out in 2011. And the way they did, they were going to eliminate the preferred risk program, but they're going to keep it. And I can't say it's going to be indefinitely. They are looking at that every year annually. I would not be surprised if the preferred risk policy that gives rate relief to our clients doesn't get eliminated in the future just because of the unprofitability of the program. If you do get an elevation certificate, it can lower the premium. Timing is also important, as much as most pre-firm buildings have only one chance to grandfather and lock in the existing zone for future rating. I'll talk about that later also. Both options should always be evaluated. Flood insurance program rates are regulated by the federal government. So what happened with all this is everybody was screaming and yelling at their Congress people, you know, we can't do this, you know, the real estate market, you know, the houses aren't selling, people aren't qualifying, they can't afford the flood insurance, and that's why they've been making all these changes. They're trying to make everybody happy, but I can't see how they're ever going to get this profitable and make everybody happy. I do think we're going to see some changes going forward. Just remember, the flood insurance program changes twice a year. There's new releases that come out, which makes it difficult for everyone to keep up with all the information. Some possible discrepancies that you might hear when you're going out of there in the community when you're dealing with your clients is, because it is mandated, the program, by the federal government, all rates are the same. So it doesn't matter if you call 10 insurance companies, you should be getting the same rate if you're giving all the same information. The discrepancy could be an experienced agent that's not familiar with FEMA's rating and how you have to plug it into the system. Or it could even be the flood zone. You could have an incorrect zone. The mapping could be incorrect. Somebody could know about a different way to manipulate the system. We're putting in the preferred program, or they could be grandfathering it or assuming the policy at the closing. The type of house and the basement location is a huge factor, because if you're in a two-story colonial and it has a full basement, that's actually 3 stories when you rate it in the flood insurance program. And also the coverage and the deductibles could affect the different premiums that you receive when you're calling around. There is some flexibility as far as things agents could do for their clients, but you have to be knowledgeable in the flood insurance program. One of them is they could go ahead, if you're in an A or B zone incorrectly, you can submit a LUMAR. A LUMAR is a letter of map amendment or a map revision. And by doing that, you submit that, and they end up grandfathering the zone. We can do that for you. LUMA can do that for you. And in some cases, what happens, most of the maps are done aerial now. So what happens, they're looking down at your property, and the house might be elevated, and it's not in a flood zone, but your lot slopes and the land is in a flood zone, which has happened to a couple of our clients that we helped out recently. We've helped out 2 or 3 people getting their zone modified. So what you do is you do this letter of map revision, you send it in, and you have to do some work with it. You have to send the most recent map. You've got to get a community official letter from them. You've got to get an elevation certificate. And what you do is you request that they change the zone for you and keep it the way it was before they did this, so that you're not in the special hazard zone. It saves clients probably $2,000 to $3,000 by doing this, and you will usually be able to get a preferred policy, which is pretty helpful, and it's a good cost savings for your client. You've got to be careful with that, because if the property has some flood history, 3 floods over a period of time, they usually exclude you from doing this letter of map amendment. Additional rating elements, the community number, we got to make sure that's plugged in correctly. If it's a single family, 2 family, apartments or condos, non-residential. Number of floors, including the basement, which I have already touched on. Location of the contents, that makes a big difference too. What's in the basement? Is it on the first floor or the second floor? The deductible, coverage limits, and the foundation, along with the date of construction. Here's just a few slides of samples of how you could get just several different rates depending on how you explained your home or how the insurance agent pulled up the information on your home. If you look at the walkout grade, basement, buildings with a crawl space, those would be all rated differently, along with the slab on grade, a mobile home, or if a house is on pilings, the rating would be totally different. So depending how you explained your basement, if it's on pilings, if it's a walkout basement, that's rated differently. So there's several different factors. Some other facts to remember is the flood policy's term is 1 year. The expiration and renewal process is usually a 30-day grace period without a lapse in coverage. A reinstatement with lapse can be paid between the 31st and 90th day. Federal policy mandated by Congress, $40 on standard flood insurance policies, $20 on the preferred. Those fees are going to change, and I'm not quite sure exactly what they're going to be, but you're going to see an increase on those. And the full premium must be submitted when we submit the application to the company. So we would need to collect the full premium. So sometimes that's a lot of money someone's coming to the closing with if they're paying that homeowner's premium in full and then you have to pay the flood. That can be a big chunk of change for somebody. Another thing your agent can do for your buyers or sellers is you can assume the flood policy. They were going to take this away, but it's back on the table again, which is great because we do this quite often at our agency. If somebody's selling their house and the new buyer calls, we try, if we know there's flood insurance, we go ahead and we take care of the paperwork so they can assume that flood policy with the zone that it's at today. And it saves your buyer quite a bit of money. Not everybody knows how to do this, so you would have to talk to an insurance company that is familiar with coastal properties. But the transfer needs to be done prior to closing. If that property closes, you cannot transfer that policy and let your buyer assume it. And depending on the zone, we can keep it in preferred too. So there's a couple different options there. We would discuss it with the buyer when they call. Another thing is the grandfather rule. They were going to take this away, the grandfather rule, which would have been an awful thing because it's actually helped out quite a bit of people. It's when the flood map changes occur, it provides a lower cost flood insurance rating option known as grandfathering. It's available to property owners who have a flood insurance policy in effect when the new flood map comes. So say if you were a homeowner and you lived in that house for 10 years and the zone changed, we can grandfather that rate once they get the letter from the mortgage company stating, you know what, we just determined that you're in the zone AE, you need to get flood insurance. There's some options that we can do to help them out a little bit. And it's got to be built in compliance with the firm and the effective time of construction. In most cases, it saves a substantial amount of money. There's also, you need to let your buyers know, a 30-day wait period from the date of application. However, there is exceptions to the rule. If it is for the loan closing, we can work around that, and that would be an exception to the rule. A lender portfolio review no longer valid. if the mortgage ended up being paid in full, or if the lender found out you no longer needed flood insurance and the MAP revision is no longer valid. The flood insurance process this is something you can share with your buyers. I recommend everyone to do this just to make sure everything goes smoothly for you and your buyer and your sellers. Have your customer call the agent early in the mortgage process. When they're applying for a mortgage is when they should be calling for insurance rates, especially in the coastal properties. We need an elevation certificate to order the quote for the flood. In some cases, if there's not an elevation certificate, you've got to contact a surveyor. Depending on his schedule, that could tie you up for 30 to 60 days. So you got to get on the phone and find out what you need to do on that. And then on the BCX zones qualify for preferred rates. The preferred program has been extended indefinitely. However, that can change. So we would need to, get some information on that and see how we can help out the purchaser of the property. And if you got to do the MAP revision request with FEMA, if we decide to do that, we need at least 45 days in advance, and 60 days would be even better. Cancellations on the flood policy can be canceled any time. However, if the policy is midterm and we have to request a cancellation, FEMA can decide if they're going to give you a refund or not. It's got to be a valid reason why you need that policy canceled. And it's a very limited amount of reasons that you can do that. So again, we would have to work with the policyholder to see if we can get them a refund. Most cases, the nice thing is if the bank required it and we were able to get any kind of MAP amendment or grandfather or anything like that, we usually can get a full refund back. So sometimes they have to get through the closing, they have to pay the flood policy and the homeowner's policy, but in the end when we work through the paperwork, we can get them a full refund. And some flood facts, coverage may be increased but not decreased during a policy term. Deductibles may increase but not decreased during a policy term. The name insured on the flood policy cannot be changed without the signature of the person being deleted and a copy of the title transfer. And that's when we go ahead and we assume the policy, the new owner. Policies on buildings in the course of constructions and policies insuring contents only might not be able to be transferred. And if you're changing the mortgage company, make sure we get the new mortgage company along with the loan number. That'll help with all the paperwork. That pretty much covers the flood insurance program. I know it was a lot of information. Some of these changes were really good changes as far as keeping the grandfathering, and you can assume the policy. The LUMAR's been around for a long time, but as the program changes, those get a little bit easier to apply for. So again, like I said, make sure your buyers are calling the insurance agencies for insurance in advance, and make sure they're talking to somebody in a coastal community, agency that's dealing with these properties all the time, because the information is so different. So we're going to move on to some really good changes on the homeowners program, which we're pretty excited about being an insurance agency. I'm sure you will be too when you hear about these. We're going to start with the storm shutter changes. The storm shutter guidelines were issued giving the insurance companies authority to require storm shutters. I had gone out and talked to several real estate offices, and I even did a little presentation up here at ECAR for the brokers when all of a sudden the insurance company said we need storm shutters on any property within 2 miles to the shoreline. And every company took a different position, if it was going to be a half mile, a mile, whatever, that they wanted the storm mitigation, which is going to be the plywood shutters or the roll hurricane shutters or the plywood. Companies could decline to write business within 2 miles of the shoreline, which was a hardship for anybody calling around. We turned away a lot of business at that point because we couldn't do anything for these people. The storm mitigation included, like I just said, the plywood hurricane or the accordion shutters, or they had to make sure they had the windows that could withstand 75-mile-per-hour winds. Companies were also able to assess a separate hurricane wind deductible to the policies, which, again, that was a little different than we had in the past. The new underwriting guidelines, as a result of the Public Act 14-175, there's so many acts now I can't keep up with them, and they required the insurance department came out where they were going to require all insurance companies to resubmit their homeowners underwriting guidelines and manual rules for the department's approval. This all went on over, probably it started in the summertime, where they said we want all new guidelines where we're not going to, you can't require the storm shutters anymore. These amended the filing review guidelines related to underwriting coastal homeowners insurance policies effective October 1st, 2014. As you can see the fireworks on the bottom, it was a big celebration for all of us because as of effective October 1st, 2014, the state of Connecticut updated the law, no longer requiring the or allowing the insurance companies to enforce properties within 2 to 5 miles of the coast to install the storm mitigation. This was great news for anybody trying to sell their house or buy their house. It was great news for the realtors, the insurance companies, the mortgage officers, because now we could take care of these people and at least get them into a program so they could at least get to the closing table. The insurance company can still apply separate hurricane or wind deductibles. So they need to discuss that, because in some cases those deductibles can be pretty high. So if you look at a policy, you're going to see your regular standard deductible if you had any other claim, and then the hurricane deductible on your policy. The storm shutter revision of October is any new business within 2,600 feet from the coast, there's going to be a 5% hurricane deductible, and that's off the dwelling amount. So that's quite a bit of money. If you had $100,000 on a home, which most people don't, we're writing homes almost $200,000 is the minimum these days on the dwelling. But if you had a $100,000 home with a 5% deductible, you're looking at a $5,000 hurricane deductible, hurricane or wind, and they can do either or. And then over the 2,600 feet, most companies are doing the 2%. Any renewal business, those are changing too on the policies, where you're going to see the 5% and the 2% deductibles also for wind or hurricane. Just remember that they can't apply these deductibles or assess them to any policyholder unless the, oh my gosh, blank for a second here, sorry about that, unless the National Weather Center predicts that a hurricane's coming and names the storm a hurricane, and the winds have to sustain over 74 miles per hour in order for that deductible ever to apply to your policy. Application of hurricane deductibles, the thing is, the National Hurricane Center, again, they're the one that dictates it all, and it's 24 hours from the time the storm starts to this time the National Weather Center says that they can lift the hurricane threat, and then the companies can't apply that deductible at that point. Notification display of all hurricane deductibles, I mentioned that. I think this is great because prior to this act, nobody even knew the deductible had changed. You didn't even see it on your deck page. It's when you called, we would explain to you, your agent would have to discuss it with you when you took out the policy, but people would forget about it because it wasn't on the deck page. It has to be clearly marked on your homeowner's policy that you have 2 deductibles going forward because of this new legislation that came through. So I think that was a good change too. Some homeowner concerns. There's going to be high hurricane or wind deductibles. Most carriers are requiring the auto policy to round out the account. The homeowner is considered like an accommodation now because the chance of severity of a loss, so they want to do package policy. So with our agency, we have 18 companies. Well, out of those 18, there's a percentage of them that we can't even quote for you unless we were to package the home and auto together. And half of that is because the reinsurance cost has skyrocketed for these companies. I mean, they're facing some big premiums from the reinsurance that they have to go out to bid for, and the profit margin and the claims expense, the margin has shrunk and the claims have gone up. Some additional underwriting guidelines that I just wanted to share. The underground and above ground oil tanks are still a concern. Dogs, the Rottweiler, Pit Bulls, Doberman, Shepherds, those are still going to be a concern when you're calling around for quotes. The swimming pools, as long as the in-ground pools have a fence around them, they're fine. But however, if they have a slide or a diving board, it depends what company you would qualify for. Trampolines are still the #1 liability issue for the companies just because of the severity of the losses. When the kids are small, everyone's watching little Johnny and Susie on the trampoline, and as soon as they hit teenagers and they're coming into the house and the parents are leaving them alone a little bit, before you know it, there are 3 or 4 kids out there that are probably like 150 pounds bouncing, and anyone could fall off, and that's where you break your neck or your shoulder. So trampolines are still one of the biggest unacceptable guidelines. Some of the companies are giving a little bit more flexibility with that if they have the fence around it that you can buy for the trampolines. The age of the roof, that's still a concern. They're looking for within 20 years. The tree houses, that is a major concern still. You know how the kids used to take a bucket of nails and some plywood out and just throw something up in a tree? That's going to be a concern for the companies because in some cases they're not sturdy. Someone can get really hurt on those, so we asked the question about the tree houses. Skateboard ramps, that's another underwriting issue, along with now they're asking for steers on any stairs without handrails with more than 3 steps. That is also a liability concern, so we're asking clients that if they don't have the handrails, that they need to put them up in order to be acceptable to the companies. And maintenance issues, the days of homes having 4 or 5 cars in the yard and maybe a bunch of debris piled up here or cans or whatever, boxes in the yard. Companies are looking at that. They are saying those are all liability hazards. They are moving away from writing quantity and looking for more quality because they need to get profitable. And I know a lot of people say, oh, insurance company makes all this money, but some of these claims when you go for a liability, so a dog bite claim could be up to the limit of the policy if a little child gets bit. That's a $300,000 claim. And some of these others I've seen claims go out $100,000, $200,000. So when they're paying a claim, they're paying a good-sized claim. Some insurance tips for you, just to repeat a few things. Have your buyers call early for home insurance. If you need flood insurance and we need an elevation certificate, it could delay the closing for weeks. The time limitation to the grandfathering or assuming the flood policy. And when listing a property, this is something I can't stress enough. Ask the question if they have flood insurance now and if they have an elevation certificate, and get a copy of both for your file. I mean, it's going to make it easier all around for that transaction to go through smoothly. That's the end of the homeowners changes, but I do want to mention there is another future webinar coming up by the affiliate membership on March 25th from 9 a.m. to 10 a.m., and that is going to be presented by, the featured speakers are going to be Dave Johnson from Prime Lending, Leslie Robbins from Putnam Bank, and Mary Beth Barber from CATIC. And they're going to be doing it on the survey of the market, changes and updates with mortgage lending for 2015 that you need to know. So I hope you can join them for that webinar also. And closing remarks, it's 32 minutes, so that's not too bad, not the full hour. So if you have any questions, go ahead and ask them. We'll try to answer one or two, but we're going to try to wrap this up also because I know it's Friday afternoon and you're busy people. But I want to thank you again for joining the presentation. And if you want to call SAVA, we're always here to help you out. You can call the SAVA team. We'll be more than happy to answer your questions. My contact information right here, along with SAVA's main phone number. Hold on one second. Catherine, what do we have?
Are all policies assumable?
Marilyn Lusher. Are all policies assumable? No, and that's the problem. We got to check on that and see about that. The majority, if we get them, we can usually assume it, but there's been cases where we haven't been able to. So again, that's why I say call early in the process, because there's a lot of factors that we have to consider.
2 to 5 miles. What about less than 2 miles? What's required?
Less than 2 miles, there's going to be, you're not going to need the storm shutters anymore because that's been eliminated. But if it's less than 2,600 feet, which is a half mile, you're going to be assessed the 5% deductible. If it's over 2,600, it's going to be the 2% deductible. And I believe once you get over 5, some of the companies, some are assessing it, but most of the companies aren't assessing deductibles after the hurricane wind deductibles after the 5 miles.
What are typical discounts that homeowners might realize if they have impact resistant?
What are the typical discounts homeowners can look for if they have the storm impact windows? Well, they're going to have to give you a little bit of a discount for that. The discounts are very small, though, 2 to 5%. The thing in the past, though, you wouldn't need the storm shutters. Now that things changed a little bit, that still considers storm mitigation, and some companies are giving a little bit of a credit for that. And almost, I think just about all of them are coming out with more and more credits because of the change of this legislation. If you can download the presentation, that's something Catherine and John up here at ECAR are going to have to work out. I'm not a techo person. They've handled all that behind the scenes, so I think Catherine might send out, just let me ask her real quick. Can they do that, Catherine? Yes, they can, and you can work with her on that. And if you have any questions, feel free to call me. I think we've answered all the questions, and if anyone thinks of anything else, please go ahead and email me. Oh, hold on.
The 2,600 distant measurements, where are they measured?
And what we're going to do is we're going to wrap up. Some other questions are popping up so that we're not going to get them all answered today. So what I'll do is I'll make sure that I email you back over the weekend. And again, I thank you so much for joining this presentation. And everyone have a wonderful weekend. Thank you.